Hello, Foundations of Financial and Managerial Accounting students. Welcome to my video on the Statement of Cash Flows, Current Cash Debt Coverage Ratio, and Free Cash Flow in PepsiCo's 2019 Annual Report. On PepsiCo's 2019 Statement of Cash Flows, the basic format first is cash flows from operating activities plus cash flows from investing activities plus cash flows from financing activities equals the change in cash, cash equivalents, and restricted cash. PepsiCo generated net operating cash inflow of $9.6 billion in 2019. That means they got more cash from customers and for interest received than it was paid to employees, suppliers, and tax authorities, and for interest owed. Like most companies, PepsiCo spent more cash to buy property, plant, and equipment, acquisitions, and financial investments than it received from selling them. This makes a net cash investing outflow, which is a negative amount, of $6.4 billion in 2019. PepsiCo spent more money repaying old loans, buying back shares, or paying dividends than borrowing new loans or issuing new shares, leading to a net cash outflow from financing activities of $8.49 billion in 2019. Okay, so the first part was cash flows from operating activities plus cash flows from investing activities plus cash flows from financing activities. There's actually a little bit more. You have to add the exchange rate effect to get the change in cash, cash equivalents, and restricted cash. So most large companies, we had this subtotal, cash flows from operating activities plus cash flows from investing activities, which were negative, cash flows from financing activities, also negative. We had a subtotal of $5.277 billion. But most large companies need to hold cash denominated in foreign currencies to do business in international locations. Because these currencies appreciate or depreciate relative to PepsiCo's functional currency, which is the dollar, there's an exchange rate effect on foreign cash. This was only $78 million. So the net increase or decrease in cash is actually $5.199 billion. That's a cash outflow, so that's negative. So cash went down by about $5.2 billion. Add that to beginning cash or the ending cash of last year of almost $10.8 billion. You get ending cash, cash equivalents, and restricted cash of $5.57 billion. Now, there's information about cash in Note 15, supplementary information. It includes cash interest paid. Cash interest paid in 2019 was $1 billion. Also information, income taxes paid in cash, net of cash refunds, $2.226 billion. So the location of cash, cash and equivalents, and restricted cash. So if you just look at cash and equivalents in the balance sheet, you see 5.509. Within short-term, within current assets, you'd see a restricted cash with nothing in it because there's no short-term restricted cash in 2019. However, there is long-term restricted cash included in other assets of $61 million. So that 5.570, it's a little hard to figure out where they're getting that if you just look at the cash and equivalents on the balance sheet because there's no short-term restricted cash. The $61 million is primarily related to collateral against debt or derivative liability positions. Okay, now let's look deeper into each section. Cash flows from operating activities is by far considered the most important part by stock analysts. Like most companies, PepsiCo uses the indirect method for the statement of cash flows, which starts with all of net income. So they had net income of $7.3 billion, including the part that belongs to non-controlling interests. That's step one. And step two, takes into account items on the income statement that don't affect cash initially. So things like depreciation and amortization, allocating the cost of a long-term asset over its useful life, that does not affect cash flow. And then, it'll adjust for any subsequent cash paid or received. So non-cash revenues or expenses, Step 3 is not needed for PepsiCo, which is adding back any non-operating losses or subtracting any non-operating gains. They didn't happen to have it this year. The reason why you add back non-operating losses like loss on sale of equipment or subtract non-operating gains like gain on retirement of debt is because they belong in other sections of the statement of cash flows. Loss on sale of equipment belongs in the investing section. A gain on retirement of debt would be in the cash flows related to that would be in the financing section. So what happens for non-financial current assets other than cash, subtract increases. So if you build up inventory, that's a drain on your cash. Add decreases. If inventory decreased from last year to this year, that means you didn't have to spend extra cash to get inventory. You just sold the things you already had. For step 4B, non-financial current liabilities, what we would do, we'd add increases. So increases in accounts payable to suppliers allow us to take longer to pay. We were able to purchase more than we paid for. We'd subtract decreases. If we have a decrease in accounts payable, that means we paid more short-term trade payables than we got new credit. Let's look at the investing activities. So investing activities decrease cash with capital spending, and they would increase cash if they'd sell property, plant, and equipment. It looks like PepsiCo sold 4.2 billion, or sorry, had capital spending of 4.232 billion, and they only sold 170 million. Acquisitions of assets increase cash. These are long-term assets. Divestitures, selling them, increase cash. Purchases, so not only did they purchase property, plant, and equipment, occasionally sold it, had acquisitions, like the acquisition of SodaStream, which cost them about 1.9 billion in 2019, about 1.2 billion in 2018. Sometimes they divest or sell other businesses, so they get cash back. So those things, we not only have capital spending on businesses we already have, we acquire other businesses. Purchases of financial investments, these are mostly short-term investments. When we buy long-term short financial investments, cash goes down. When we sell financial investments, cash goes up. There was hardly any of this in 2019, but there was a lot of it, selling short-term investments in 2018. We bought some, but it looks like we sold a lot more. So in 2019, if the fiscal year ended, we actually spent more on acquisitions than we got back by selling acquisitions we already made, by selling property, plant, and equipment, or by selling short-term investments. In 2018, it was a positive amount. So actually what we did is we actually got more money, mostly from selling short-term investments. Let's look at 2019, and let's look at the statement of cash flows from financing activities. Borrowing or issuing long-term debt increases cash, while redeeming or repaying long-term loans decrease cash. This is the principle. So proceeds from long-term debt, 4.6 million, but we also repaid. So sometimes you issue new debt after you've repaid some old ones, so as you keep your credit. And it looked like we had some short-term borrowings that we repaid, but not very much. Cash dividends and share repurchases, which PepsiCo did a whole lot of. So most of what happened is we not only paid over 5.3 billion in dividends to our shareholders, but we bought 3 billion in PepsiCo shares, common and preferred. So we paid dividends, we repurchased common shares, and shares that were purchased, preferred shares that were repurchased were from earlier years. So we not only have a high dividend, we also buy back shares. So PepsiCo is a mature company. They use a lot of their cash to do that. Issuing new shares, including the amount received when companies exercise stock options, increase cash. So proceeds from exercise from stock options increase cash by 329 million, net of tax withheld on this form of compensation. So we have information. They either issue new shares or they didn't necessarily issue new shares, but they issued shares for stock options. So they didn't issue new shares to the public. So for financing activities in both 2019 and 2018 and 2017, we used cash. We spent more cash than we borrowed more money or issued new shares. So we spent them mostly on cash dividends to stockholders and share repurchases. If we want to look at ratios, one liquidity ratio, I'm not requiring you to calculate this, but this is in your book and I thought I'd show it to you, would be looking at the current cash debt coverage ratio, which takes cash flow from operations divided by the average current liabilities. So cash flows from operations in 2019, about 9.649 billion, divided by average current liabilities last year and this year of averages to 221.3 billion. So we have about our cash flow from operating activities without borrowing or anything is about 45 cents worth of current liabilities, would pay about 45 cents worth. So the 2019 current cash debt coverage ratio of 45 cents for every dollar of average current liabilities is that. And if we look at PepsiCo in 2018, the current cash debt coverage ratio is a little bit less. So PepsiCo was very slightly more liquid if you look at the current cash debt flow, current cash debt coverage ratio. Very little bit, about the same, a tiny bit more liquid in 2019 than 2018. The ratio was pretty consistent. Solvency is the ability of a company to survive over time. Does the company generate enough cash flow from its operating activities to pay for capital expenditures and cash dividends? If you wanted to look at this isn't a ratio, but a dollar amount, you would look at what our book calls free cash flow and how the book defines it: net cash from operating activities minus capital expenditures minus cash dividends. And we'd look in the statement of cash flow, net cash from operating activities from the operating section, capital expenditures from the investing activities section, and cash dividends from the financing section. That would give us free cash flow. We see that most of our cash from operating activities was used for capital expenditures and dividends, leaving very minuscule amount of free cash flow, only 13 million out of 9.6 billion of cash flow from operating activities. So that means, as I said, most cash flow was used up to pay for capital expenditures and cash dividends in 2019. PepsiCo was less solvent in 2019 with only 13 million in free cash flow versus free cash flow of 1.2 billion in 2018. PepsiCo had 9.415 billion, about the same amount of cash flows from operating activities, but they spent less on capital expenditures and also cash dividends. So mostly it's due to spending $1 billion more on capital expenditures in 2019. That's one of the reasons why we have less free cash flow. PepsiCo actually gives a calculation of how they define free cash flow, which, surprise, is higher because it excludes cash dividends, and it also adds back sales on property, plant, and equipment. So in management discussion and analysis, sometimes they will calculate their own ratios, and you sort of have to say it's not always going to be what's in your book, and PepsiCo calculates it to make it look more favorable in 2019 and 2018 because they don't take out the cash dividends paid. Please feel free to use this presentation as a review before looking at other companies' annual reports. You don't actually have to use these ratios on the weekly discussion board, but it's good to know you can look at your own company's annual report and calculate them if you wish. Good luck and get started, Jaspers.